This is Justin Pulitzer. This is my weekend review video for Sunday, May 22nd, 2016. Good amount to cover, but we'll start out with some good housekeeping. First and foremost, I want to apologize if you had a junky version of Periscope from Friday. I think the service was having trouble, the video was cutting out, and so on and so forth. Nothing I could control over that. I think it's a bit better on the YouTube rebroadcast. I was able to clean up some of the coloring, but that hopefully won't happen again, and this video here should be pristine. Speaking of this video here, if you happen to watch it after it's immediately uploaded, sometimes for whatever reason they don't render the higher resolution versions as quickly. So if you're seeing this and it's blurry, just pause it and reload it a little bit later. It can be seen in up to 4K. It's actually shot above 4K, so if you do have a 4K capability, this should be spectacularly gorgeous. Anyhow, let's jump right into it. We had a fairly tumultuous week, although you really wouldn't know it by the VIX and how it closed. I usually like to start out with the 6 market keys, flow into the 7 Fed keys, although lately I've been commingling those two because markets and the Fed are ever so commingled these days. If anything, the market sometimes is the Fed. So let's do that. We'll get into the major market indices and then hit up some stocks. So with regard to the market keys, the VIX, as I've shown you, has been rather tame. There was a bit of a scare Thursday. We've been transitioning, however, with some higher lows and some higher highs, but it's been very difficult to get back into this potential up channel. Most all attempts here have been rejected and come back down quite violently. Thursday closed with a pretty nasty topping tail, and then Friday volatility just got slammed all day, I think, once people realized the market was going to not implode. Based on sentiment, I'll tell you, I used to talk, for those of you who have been following me for a while, I used to talk a lot about my fade list. I have not talked about it recently for a few reasons. One is that I was badgered daily with people asking me who was on that list and how can they get a copy of that list. That is proprietary and something I am definitely not willing to share. I am not willing to come out publicly and belittle people either. So I keep that to myself. For those of you that are newer, I will explain the fade list. The fade list is basically people who I've observed over time who are usually wrong. The list does exist. It is just not being talked about as much. I use this to gauge market sentiment. I also have been using to various degrees of success the Twitter polls. I think it gives I don't have the largest number of following, but there's well over 7,000 people now, and I think most of them are pretty well educated in the markets, or at least active market participants, and it's often very helpful to get a gauge of where people are, where their heads are. About a week or so ago, I ran a poll, if you're bullish or bearish. It was roughly 55 to 45 in favor of bulls. I think this week it was just the flip side opposite, give or take a point or two. It was basically 55 were bearish and 45 were bullish. I think it was a little different, but let's not let the facts get in the way of a good story here. It's roughly about that. And the sentiment, I think, has turned a little bit as the market, has come back a little bit. I think that has a lot to do with who's in control of the market. I've talked about not really seeing a lot of the OTF, meaning the other time frame, big money, the institutional type of traders. It's really just been basically the market being bandied about and batted around with, day traders, swing traders. Not to say that their money can't move markets, which we know they can, but it's not the amphalotic selling or amphalotic buying that you might see from a 50 caliber machine gun, the type of moves that the OTF can do. Let me just go through some of this with you. So I showed you the VIX. I think we're in one of these periods where the VIX is sort of in rather tame volatility with momentary spikes on panic on things like the Fed or junky numbers or whatever geopolitical events, or shootings at the White House like we had on Friday, although that didn't really wind up, I think it was too late in the day to do much to the tape. So that's the VIX. For those of you who are new, I created a VIX key. This is how I use the VIX. A lot of people like to trade the VIX directly. I don't. I usually use it for selling or buying premium, particularly in SPY options. This is basically the gauge of volatility for the SPY. I also use it for, stocks in general. If, this gets too low, down in here, I'll book some positions. And if we start getting up into here, maybe I'll put on a little bit more risk. So that's my take on the VIX. I've talked about the Fed and some of the things that the Fed are looking at. The dollar chart is definitely one of them. I use the UUP because a lot of people don't necessarily want to trade DX, but they would be into trading the ETF. TLT is an ETF for bonds. SPY is the ETF for the S&P 500. So UUP is the power shares US dollar, the long dollar. So I wanted to show you, and I'll probably show the DX anyway. We had a big run up here in the dollar, and we've been going sideways, and I drew in some channels, and moves below have been, unsustainable, and moves above have been unsustainable. The dollar is entering, kind of the last leg of maybe a rally phase. We are coming into some resistance points that I've drawn in. This is one, the downtrend. It's held it a little bit, although it hasn't rejected it violently. And two is sort of a informal regression line that I've drawn in and coming into a volume distribution. I think that's illustrated a little bit better in the DX, and my charts are frozen. That's always not very helpful. We'll give it a second. It basically shows the same. Here we go. The DX. Here's the dollar. Yeah, there we go. Let me zoom in. So you can see we're in a bit of a downtrend here. We're coming up into that same downtrend. This was also kind of a point of contention. So it wouldn't surprise me to see a little bit of a pullback with regard to the dollar. I was looking at it in a chart earlier that I saw a volume edge distribution in there, but you can see we have two topping tails here. It hasn't rejected, although if you can get a move below these double day lows, so below 95.12 half, I think you would see a quick retest of the 50-day and the 10-day moving average at the very least. If this does pop through, that could get a run up to 96s, maybe a 200-day moving average test. That would obviously be not so great for the stock market. I've talked about this being a tailwind for the market, and it moving up would be a headwind. Basically, U.S. companies that do business overseas have a repatriation issue, and if they, here we go, and then this is perfect. They have a repatriation issue, and that basically benefits when the dollar is weak and is not so good when the dollar is strong. If you're doing business overseas, you want a weak dollar. You can see here is on the 9-month is the volume distribution. We are coming back into that area. You can see it's all up into this area. So there could be a little bit more bounce in the ounce for the dollar, so to speak. You could get a move up to here, 28, 24, 81, 82, this area. And then I would think that we could probably get a bit of a back off. That's just my thinking with regard to the dollar. I think this just got way, way overdone with some of the economic data that came out and the Fed sentiment, and this is just a healthy bounce. You can see we're basically into the breakdown point. I think a lot of people like to, particularly the news media, like to have a narrative every day, and they don't just say, hey, the dollar got overdone, it needs a bounce. Now, everyone's worried about the Fed, which we will get to in a moment. The bonds. The reason why the S&P has stayed so strong for so long, higher for longer, I guess, are the bonds. This is the end of the world in 2009, and you can see bond prices are stronger than they were back then. This, I think, was the debt ceiling crisis. Bond yields are basically still elevated. Why? lack of money demand. Banks have been regulated. Banks have been neutered. There is very little visibility in the business sector. There are new regulations. There are new taxes being levied regularly. Uncertainty about the economy, geopolitical risk. This is made for a witch's brew of uncertainty and lack of investment. We know that companies are basically spending their money on dividends and corporate buybacks. They're not investing in their businesses, although the Fed is trying to give them every opportunity to do that. Hurdle rates on projects are fairly low, I would imagine. If you can, if you're in the public market, you can borrow relatively cheaply. We know Apple has been buying back stock at sub-government rates. But what have they done with it? They haven't been making huge acquisitions. They haven't been making tremendous investments in terms of property, plant, and equipment, although they are building a relatively swanky new headquarters. But they're mostly using it for share buybacks and to pay dividends. I can't say that they shouldn't be doing that. That's really their prerogative, and I guess good for their their investor base. But it isn't great for the for the economy. So as long as this bond situation stays as it is with relatively high bond prices and relatively, or absolutely, I should say, low yields, stocks will remain at a PE multiple premium. So the market is currently trading at about 19 times earnings. The only way that is possible is for people to be chasing yield and for we all know that the earnings quality haven't been good. We know that we're having a growth slowdown. We know that the earnings picture hasn't been great. But because of what the Fed has done, even those relatively meek and weakening in many instances earnings are getting a PE multiple premium because it's basically the only game in town. You can't go to your bank and do much with CDs. You buy bonds, you're not going to get a lot of yield to live on, so people have been forced into more risk asset instruments. We all know, and this is pointed out, I have a lot of people who are very dogmatic bears on my stream. Yes, we all know that this ends badly. In the end, bull markets are basically sown to crash. The seeds of their destruction are embedded in their success. But that could take a lot longer than I think people realize. There are some people, I, again, don't want to mention any names, have been talking about, big, market tops for a number of years now, in some instances since even 2012 or 13, and it's 2016. And basically with every, downtick in the market, they feel they've been justified only to see the market rally up quite a bit and stay stronger for longer. So just keep that in mind. Janet Yellen talked in one of her speeches about normalization and what normalization might look like. We know that markets have crashed after the Fed has raised interest rates to 6%. That was the case in 1929. That was the case in 2001. That was also the case in 2007. And the Fed has now said that their new norm, instead of 6%, will be 3.5%, and that could be years down the line. So that PE multiple premium could last in the markets a lot longer than shorts may be able to stay solvent. That isn't to say that there aren't going to be pullbacks and scares and so on and so forth. But as far as, the 60% type of bear market that we saw in 2009, that was created by a credit crisis. Keep that in mind, credit crisis. That is what leads to bear markets. Recessions and credit crises, we don't really have a credit crisis here at the moment. We have a pool full of liquidity in terms of QE that are sitting on bank balance sheets. So the probability of banks really, at least U.S. banks, I don't want to talk about European banks or Asian banks or any foreign banks, but as far as U.S. banks having a banking crisis here, because of liquidity, it is highly unlikely. Yes, there could be exposure that, who's in bed with who has exposure to, banks that could be, in trouble overseas. That's a different story. But as far as the type of systemic crisis that we saw after 2005, which really culminated in 2008. I could even make the argument at the end of 2007. That is not evident at the moment. So that is that. HYG is kind of the barometer. I think the simple man or layperson can use if you don't want to look at LIBOR spreads and you don't want to look at CDS and you don't want to look at tranches and mezzanine debt and so on and so forth. You can just look at HYG. What got the market, flash crashy and, panties in a bunch, so to speak, was this selling, this very large drop in HYG. And I believe a lot of that was a result of the fall in oil. A lot of companies took on a lot of debt in that industry, and there was a fear as oil dropped that there would be major defaults. We know oil has rebounded quite significantly, as has these debt instruments. There have been some bankruptcies, but they're not really in like the big companies, so to speak. You're getting, Lin Energy went bust. There was a bunch in the coal industry that went bust, but you're not going to have like Exxon Mobil, go down. I mean, if anything, they kind of thumbed their nose at S&P a few months ago. S&P downgraded them, and the next day they came out and raised their dividends. So it was sort of like, we got hand. You can see that this has stayed fairly strong, even in the pullback that we've had in the market. It's been rather gentle. If this can kind of just stay or slowly continue the rise or just not dump, have one of these type of moves, I think that it takes the credit risk out of the market. We can see we're about to have a golden cross of a 50-day closing over a 200-day moving average. I don't really pay much attention to that stuff. I know the media likes to go on and on about it, but not that important. You can see here that once the 200-day was really definitively broken, though, moves above it and even touching it have been unsustainable. We're well over it, and we now have 250-day moving average support below, so I would say that that is looking a little bit better at the moment. The Fed does look at that. Speaking of oil, let's just look at it. I talked about there being a long-term trend line here that had been broken, and moves to it have been, and moves above it, have not been sustainable. My target was basically the backside of that trend line and these reference highs here, the 49s. So that has been my call for a while in oil. We got there and quickly backed off. We got back up again, backed off a bit, and we are consolidating. That is actually rather good. If you start seeing oil fall apart too steeply again, getting one of these, the market won't like that. Oil has been programmed into algorithmic trading. Whether or not you agree with it or not, this is what is happening and is being used as a global proxy. And while the ratio isn't 1-to-1 with the S&P, if oil is going down in a precipitous way, the markets usually tend to go down in a precipitous way. We are above the 20, we're above the 10. You have the 200 and the 50 well below, although the 200 is now for the first time in a while starting to bend back up. The 50 is clearly in an uptrend. The 100 is clearly in an uptrend, and we're above the 10-day. I'd actually love to see oil do something like pull back and test the channel low for a right or right out re-entry, but it could just kind of stay sideways. I think longer term, oil will probably see in the $65 to $75 range for a while, but I do think that this upper 40s to maybe 52s will hold it for a little while. I think that it needs a little digestion time. XLE, which is the stock kind of amalgam of oil stocks, broke out of, look at this down channel, or this, I should say, downward pattern we had been in for quite some time. Had a test, broke out, retested the backside, and is now kind of just chopping above there, kind of got a little overbought, backing and filling a little bit. There's not much to say here. It's above the 200 as long as it's, in an uptrend. We're making higher lows, higher highs, although here we're kind of just chopping a bit. I think as long as you're really above the, as long as you're still in the uptrend, I would say that it's kind of okay. Don't even need that. You can use the, yeah, see, we already had the, I guess, the golden cross here. So if you're immediate term, you can use the 50-day. You can see the 50 here was a lot of support. When it was lost, it was trouble. I think you could use play long against the 50 and maybe, I guess, short if it's broken and confirmed, a move below. See, like here, you had a break, but the next day it didn't confirm. It went higher. So I would like to see, a break and a confirm for me to really start changing my thesis in oil. My favorite of the oil stocks is ExxonMobil at a new 52-week high on Friday. All right. Not much to say about that, except it is riding the upper kind of trend here. I still like it for buy the dips. I'm okay with oil as long as we, if I'll tell you this. When I look at oil and I look to see if moves are real, we've seen oil pull back a little bit, but Exxon has been in beast mode, even making a new high on Friday. So I need to start seeing, XLE going down, oil going down, and then Exxon kind of giving up the ghost. I would love a pullback in Exxon, maybe to the 50-day moving average, which kind of coincides with trend, although it'll be well above there likely by the time we get there. As a right or right out instrument. You can see it was a little resistance here, and we haven't really tested it in a while. I think at the very least for a day trade, maybe even a swing trade, the first test should hold. The 200 has also been an important level. That's a lot lower, down at 80. That will probably come up to the 83s at some point. Everyone's known for a while. I like Exxon over 83.01. I've explained in past videos the importance of that. You can see when this breakdown took place, that's really where it happened from. So I kind of use that line of as a line of demarcation. I like anything Exxon basically is, and global growth as measured by oil as being okay as long as we're over 83.01 to 84.70. So that, let's just keep it simple, stupid at that. China. So a lot was made of these Fed minutes. They were hawkish. I don't BS anybody. If I think something is bullish, I say it. If I think something is bearish, I say it. As I've said with the Fed, I think I have a pretty decent track record with the Fed and calling what I think they'll do and interpreting their sort of entrails. This was a bit more of a hawkish tone. I think that these minutes took place when FXI was doing better. We know that the Fed looks at a few indicators. They look at the S&P, they look at the HYG, which is, the more risky bonds. They look at China, they look at oil, and they look at the dollar. We know this because they've told us that. FXI has been in a bit of a pullback. I was hoping for a 61.8 test. We didn't quite get it, although now since these two lows were close, you might see a bit of an overshoot. I'd be an interested buyer anywhere down in these like 28s, 29s for a right or right out long. China, though, is still in a downtrend. It has not, turned the page. I think that, along with the potential for Brexit, the British exit, should keep the Fed on hold. I've also talked about, and I guess I'll just get into it now. Look, the jobs numbers are not good. Look at the NFP. This is the measure that the Fed looks at for the jobs. The consensus of the last read was 200. The prior number had been 215, so this was going to be lower anyway. They revised the prior number down to 208, and this one missed by 40,000 jobs. It was only 160,000 jobs. Private payrolls were abysmal level. The participation rate is actually a little bit worse than the prior read. The other one had been 63. This is 62.8. This means the percentage of the population that is participating in the labor force. Average hourly earnings was up slightly. This one was revised down, and this was basically on course. The average hourly work week is below 40. What does this mean, this 30.5? So based on the Obamacare, the Affordable Care Act regulations, you need to be 30 hours plus. Anything over, if you're 30 or more, you get, you qualify for health care. Anything below that can be considered part-timing. It does not surprise me that this is just slightly over you can't run an entire business with part-time employees, but this is to me rather weak. However, the Fed, let me get rid of this. The Fed, in their infinite wisdom, decided to talk tough. So the expectations of a Fed rate hike have increased quite significantly. I had talked about this getting a little ridiculously low. It had been like in the single digits, and I thought it would back and fill a little bit. I thought particularly ahead of their meeting. I did not expect it to have as dramatic of a jump. June is still likely off the table. According to this, it's only 26% because of the Brexit vote, which comes the following week. However, July, which is a what the heck is going on here? July, which is a non-press conference meeting. A lot of people think that the Fed can sow the seeds for it in June. July is now at 53%. This had been this is showing, these numbers are not correct. This had been rather low also. It is now really jacked up. September had been well below 50%, now it's 64%. The only time you had been above 50% was in December. So what was looking like a one-and-done rate hike in December is now looking like maybe 2 or potentially 3 rate hikes, again, coming in over the summer. All right, my interpretation of this. So Janet Yellen, in her last hurrah on 2/16, she talked about a lot of stuff. Global risks were emphasized. That talk has been brought down a little, I think, because China had come up, although we know it has come down a lot since, and their numbers have been abysmal. She talked about dollar and energy. Energy has rallied quite a bit. She had said that was transitory as well as the dollar. Those trends have moved in her favor. So I guess she can put a feather in her cap with that. She talked about GDP being just a touch lower than consensus. That has remained abysmal. The Atlanta Fed is who I look at for my GDP rates, and they have been basically in a foot race along with Wall Street banks to cut their expectations for GDP. I think it's now 1.7%. We know the first quarter was terrible. We know we had Q2 revisions down so far. They've been crappy. There is really very little growth in not only in the U.S. economy but the world. So I don't really see the Fed wanting to really hike after the jobs numbers missed and the GDP expectations have come down. ISM is really not that much to write home about. I know the manufacturing one was above 50, was just above 50, which is the demarcation line for growth. But the jobs number in there was a recessionary number. It was like in the 48.9s. Service PMI is nothing great to write home about. PMIs, same deal. Durable goods. So I've talked about housing being good. We had a inflation read a few. I think it was CPI. I forget what it was. For some reason, the term is I can't. It's not coming to my head at the moment. Once in a while, I have these lapses. With all these crazy acronyms, but the only numbers that were up were basically oil, gasoline and oil, and rents. And I think that has been as a result of the poor economy. People don't have savings and don't qualify for bank loans to become owners. I think after the fiasco that was 2005 to 2007, where loan discipline was just completely out the window with ninja loans and so on and so forth, where janitors can buy $3 million homes. That has now gone the opposite way. I know that as a firsthand. I recently had bought an apartment, and I know the application process for mortgaging was quite extensive. Autos have been doing well, but again, these are both indicators that are very reliant upon lower interest rates. As interest rates rise, you will see housing and autos have issues. Rents, though, have stayed stubbornly strong. I looked at a historical, I don't have the data in front of me to show you, but you could just take my word for it. I do quite extensive work on this stuff. We're at about 6% more rentals over historical owners than normal, and simple supply and demand. If you have more demand for rentals, the price will go up. That is what's taking place. You also have millennials who are living in their parents' basements And once they get a job, yippee, they don't have enough money to necessarily buy, but they can rent, or they can get together with a few of their friends and, do the roommate situation, Airbnb, whatever, and they get to, live alone. So that's really what's going on there. We know aircraft have not been doing well as measured by Boeing, and then, there have been some blips up in terms of durable goods with people, for the first time after being under their, I guess, desks for 10, 11 months. They bought, some toasters, but it's really not a pretty scene. Let's go back. The other risk-on, risk-off gauge that I look at often is IBB. Not a pretty picture. You can see it had a head and shoulders top. A breakdown on the flash crashes probably was more than it should have been just because of the situation it was in. Did rally back for the neckline retest. This is really, by the way, people talk about short selling. They always get excited on neckline snaps. I don't really. I get excited on neckline retests that fail. Those tend to be the longer term shorts that you can hold. And you have great trade location for right or right out instances. See, this was like a trend line test and a neckline kind of retest. It wound up being really a great trade. This was consolidating for a bit. It wound up breaking down. I've talked about this level, the 275.40. You can see that this was this high and area point of contention. Once you kind of gapped and went above there, it wound up being important, and we have been below there for a little while. 271.77 to 275.40. As long as IBB is below there, I believe it to still be vulnerable. You can see it kind of had a bit of a rally attempt back into these lows, which became resistance, and it's come back down. Why do I think this is happening? One, technically, the pattern looks terrible, but fundamentally, I think it's just because every politician, Trump, Clinton, Sanders, they're all talking about lowering drug costs. I think that is going to have to happen just because it's bankrupting the entitlement systems as well as Americans. Those costs have gone up astronomically. I don't really care what the official numbers are. I know firsthand from having to be in the marketplace buying my own health insurance. After like 5 years of 17% year-over-year increases, it is now like 30 to 50% year-over-year increases when you factor in the deductible and premium jumps and, things you have to copay on. So prices have gone up, benefits have gone down, not benefiting anybody except insurance companies. Drug companies, though, some of them that charge a lot, we all know that that Scarelli came out and he had raised all the, those prices. The whole industry is under a lot of scrutiny, and it wouldn't surprise me to see a 1.618 Fibonacci extension down, or a bring down to where this kind of all got started from in the lower 200s. I don't know if it'll be a straight line. It's very possible that we're, just building some sideways action and then we'll get a move back up. But as long as we're below that 275.40, I am cautious to say the least. That's confirmed by stocks like Gilead that just can't get out of their own way. This rallied back up and came back down, and look, the bounce down here has been rather meager. This is starting to look like a big rounded top. I'd be very careful with these stocks. Everyone always says Gilead's only trading 7 times earnings. When industries peak, they tend to have the lowest multiples. Just remember that, particularly in commodities. PEs always look cheapest when industries are topping. That is I'm not saying to short this here, because look how bombed out this is. Actually, I do think that this could go a little bit lower, and then it's going to get a pretty nice rally. But I do think that could be the case here. Conversely, when you have very high multiples in industries, it usually, after an industry has moved, that usually winds up being could be a bottom, particularly, again, for commodities. Let's get into the indices, the SPY in particular. Let me zoom in. 9 months daily. I wish this was a little bit stretchier here. Could we zoom in a little more? Maybe I need a 3 month. Let's try a 3 month. Let's try a 3 month daily. Yeah, that brings us in. This narrows us in a little bit. You can see I have some alerts and a lot of my levels are ticked off. A lot of my levels are ticked off. I'd actually like a little bit more to show you guys. Yeah, 6 months is okay. We had here we're forming a little bit of a I guess a head and shoulders. That's what everyone's talking about. I really see this more as a little bit of a down channel, just because it's been so gentle how it's coming down. Listen, we all know from experience that gentle moves, this wasn't really so gentle, this was very ferocious, but before there, you could have gentle moves that start off slow and then they get steep. This has been very begrudging. These days here, the bears were trying to sell the market off on positive breath. Same with all these days. They've been rather meek. Actually, up days have had stronger breadth and internals than down days have had bearish internals. So the up days are stronger to the upside than the down days are ferocious to the downside. We had here this day. This was the Fed kind of day. It didn't end well. We ended low in range, although look, you can still see you kind of closed with inside this body. You had a look below and fail here. I've talked about 214.12 days when we have had. Let me give you a little more perspective on that. Sorry, we got to go back in time. Got to go back in more time. I feel like load up the DeLorean here, right? Here, look, we had close here below 2. This was a Friday. A close below 204.12. We know what that resulted in. Same business here. Nasty. Here we had the bit of a look below and fail. This closed at 204.20, so kind of holding on by the hair of its chinny chin chin. And then we had a gap up and it rejected at the 50 MA. It closed kind of okay. We closed above this day here, which was the most important for me. This was the Yellen day for all those interested, where she gave the speech. The high of that day was 205.25. I have this range here as marked as 205.23. We're going to change that now officially to 205.25, just because that was the Yellen high of day. And this bar to me, anything above that bar to me remains bullish. Anything below that low to me gets a little bit more iffy. The old range, there was an old range here low. This was an old high, which has been support also for a range low. You can see here of 201.90. We got a little close there. I would have actually liked to have seen this get a little more stretchy, but it didn't happen, which is, I guess, a little more bullish than bearish. Everyone I know, or I should say, has been following, anyone who I should say who's bearish is, all excited about this head and shoulders top. But it's kind of like saying that it's raining outside. And we all know when it rains, there's days of drizzle. We know that there are Category 1 hurricanes. We know that there are Category 5 hurricanes. If I had to categorize this type of move that we've seen, it's been rather garden variety, maybe summer showers. Really not that amphilotic selling that we talk about. 204s have been rock solid support here. They were again. I will say this, the more times you bang on it, the weaker they will become. The bears here this day, to me, this was rather telling. They know that the Fed was hawkish from this day. They know that rate hikes are being more rate hikes are being factored in. We know that earnings and so on and so forth haven't been good. Disney had a big gap down. We've had Home Depot couldn't go higher on good earnings. I mean, everything was kind of lining up for the bears, and they couldn't even do it. They had a look below and fail, and then the next day was a gap up. So this day's range to me is going to be really important from now on. So anything to me above 204.54, I will remain constructive. If we can get above these highs, like above the 206s, 207s, I'll be more bullish. If we were to take out this low of day, this hammer, I think that the bears would finally get what they're looking for, and they could get a 200-day moving average test and maybe even a 100-day moving average test. We are very far away from the significant, the first significant Fibonacci level is always a 50% fib. That's down at 196. We are a long way from Kansas Toto. yeah, so if we start getting closes below 204.12, we start taking out this hammer, I'll start getting a little more bearish, thinking that we do need a little bit of a washout. But, as long as we're above that high, I'm going to be a little more constructive. And then once we start taking out these highs and the downtrend, then I'll be still more constructive. I'm a little more neutral to bullish now, believe it or not. If we, like I said, if we get down here, I'll be more neutral, and then below here, more bearish. Although until we really violate the next range low, the 201.90, I'm not going to get like crazy bearish. If that happens, then I'll be thinking 197s to 196s. We'll see how that goes. So that is SPY. The expected move this week is man, I'm not even looking at the right number here. That's not good. The expected move this week is $2.84. If the move is down, it will likely be more. That would roughly be 202.65. So I would assume that at the very least we get the channel low. 208.33 would be the range high. So we would be back up to here. You can see we had double tops at this this shoulder. I talked about this being more nuanced. The fact that this high here eclipsed this high. Granted, this was only one day, but it still made a higher high, kind of on a leg range than we've had. Kind of mucks up the pattern a little bit. Also, that the right shoulder, potential right shoulder, is higher than the left. That's also makes the pattern a little harder for follow through. If we were to take these two highs out, this 208 half-ish level, I think we'd easily see the old all-time high and likely a new all-time high. I know nobody seems to think that that's possible. I think it's very likely if we, could come up here. Based on this type of selling, until I see down days with 5-to-1 and 8-to-1, I think only one of these days had those type of trend day type of internals, and I think by the end of the day, it wound up being kind of like okay. Until I start seeing that, like the gap and go kind of days, like I want to show you on a chart what I'm thinking. No, we are in a 1 year, so I could show you. Until we have one of these, look, like when we start seeing days like these, then I'll start getting more convinced. But we're not. We're just seeing, kind of these chop, this chop. You can see what happened here. Eventually, this ended in that, but it might not be. This move down was really bearish. This was clearly an obvious check back. This move down was even more bearish considering we took out these lows. But now we're back up to these highs. It's looking like a big W pattern. And frankly, it to me is starting to, it just doesn't make sense that we would be back up here. The pullback is obvious. We got to the 210 to 11. It's been, a few weeks. It's been rather gentle. We haven't even gotten a 38.2% pullback. We're still in the upper distribution of the range. I mean, it's hard for me to get really super bearish, like I said, while we're in the upper distribution. When you get closes below, that's when the trouble happens. And here the look below is a look below and fail. So if we can start getting back below there, then I'll start getting a little bit more excited in my short book than I am now. That is that. IWM. This should be no surprise. I drew a box here of an upper distribution. We basically got a tiny look in and fail, and the pullback has been rather gentle. Look at Friday. It actually closed above the downtrend in IWM, albeit a bit. We did close over the 50. We're still below the 200-day moving average, which is an important level. We kind of had been above it. Now we're a little back below it, but I mean, look. I mean, we're closed above the downtrend on a Friday. That's a weekly bar now closed above the downtrend. So it's again another kind of a feather in the cap of the bulls. I mean, you may have a secure low here now. I mean, that's a low bookended by two higher lows. I mean, you'd really have to lose this entire day. If you lost this low of day in IWM, the 109.23. Then I would say you want to play short. Anything above there, I think, is still bullish. So let's use Friday's range as a gauge for that. Qs. I pointed out that this 204, 205 level was key. It's held there so far. Until we start losing 204, 205, it's hard for me to get super bearish. And even if we do, look where the trend line has come up so high, you might get a false breakdown and maybe only a move down to like the 101s. I mean, that's, not the end of the world. It's close to the 50% fib of the range. It just, to me, looks like it's kind of building pressure either for a larger snap lower or for a snap move back higher. A lot of that is going to depend on the big NASDAQ names like Apple. I know this chart is a little bit iffy in terms, I shouldn't say iffy. It's really a little cluttered, but just stick with me for a minute. You had this range here, these 92s were important. That was the flash crash low. They held basically here. Here they were holding again. Here we had the snap. Then you had a weak bounce, which kind of closed toward the lower end of the range, and then Warren Buffett and company stepped in and changed the pattern. This to me now looks like a look below and fail. So as long as we're above 92.78, which was the high of day for the fake breakdown bar, I think you can still stay long Apple. Apple loves to fill earnings gaps. At some point, this stock will be 103 or 104 again. It's also a 61.8 of that move. I just don't necessarily know that we don't need to come down first. It's sort of looking like we might fill the gap, and then maybe there's some come down ahead of the earnings. That would actually be a really great setup. But, I had been looking for a move a little bit lower to maybe to the 61.8 and the primary trend. I think Buffett and Co. messed that move up. I think it would have been more secure and a healthy low, and this would probably be a little less begrudging if we would have gotten that final kind of washout capitulation. But what you did get is a lot of people sucked in short here, and they're all now wrong. So, like I said, Apple is a long anywhere above 92.78. Anything back into this range is a little more iffy. Let's just keep it simple, stupid. That's what I love to do. Facebook, holding up kind of like a champ. I talked about this 116s. You can play right or right out long there. You could even put on some put ratios I said I liked. As long as that holds, the path of least resistance is still higher for Facebook. I do think, based on these patterns before, these consolidations, there does wind up being a bit of a break. I would love to see a trend line touch. The 200-day moving average here has been rock solid support. It's right near the channel low. I would love to see a test of that for a entry point. That to me would be great. It would be great even further if it came up here, the 200 MA and like the channel wound up being the gap fill. Imagine that. It came down to a gap fill, the 200 MA and the trend line. Could anything line up more perfectly technically? Also, the range distribution here. That would be, near the 110s, 109s, 110s. So I like Facebook longer term. I am still a little cautious short term. As we, have come up near the progression line, I get iffy. When we get too extended below it, I get more bullish. So Facebook, I think, just needs a little bit more consolidation. I'm still more bullish longer term. Amazon remaining pretty bullish, above the old all-time peak here. Seasonally, this isn't the best time for Amazon. I would love a trend line touch as a right or right out long. Even if it coincided with the 50, it would be even more perfect. I don't necessarily know that you go chasing Amazon here. It's definitely run up quite a bit. I do think that there could be some pullback and consolidation, but this isn't exactly screaming bear market. When you're in a bear market, all stocks go down, and when you're in a bull market, basically all stocks go up. You still have sort of like these actualizer situations where you have some strong stocks being up on down days and remaining strong in pullbacks. That's not really what happens when you're in a really nasty bear tape. Netflix, they didn't have the best of quarterly reports. I tried this long. I was stopped out. It's just been really, really choppy. It's a really messy pattern here down here with some lower lows and then some equal highs. I think it will break out of this pattern eventually, get a 50 MA. I think this will test into the gap at some point. This area has been some key support around the 86s, so if you want to play long, I guess you can use that. We're above the 10-day. It's just chopping in a range. I don't really see that. They could be forming a bit of a rounded bottom. I don't think Netflix is going to completely fall apart until it has at least some type of a rally, but the pattern is a little more iffy on that one. Google I've talked about. I don't like to mess around with Google when it's in the middle of a range. It does seem like it's kind of working its way lower. I will be all over it for right or right out long. somewhere around the channel low when we get there. Maybe it happens on the next earnings, who knows. But I like to short channel highs and buy channel lows, and the in-between to me is really chop. I don't like to play around with it. Also, if we were in a super-de-duper bear market, Tesla, they did a secondary offering with Goldman Sachs. Crazy that Goldman announced that they were the underwriters on the stock. They announced they upgraded the stock, and then that night they did they offered the secondary. Really eyebrow raising. I think this got so much of attention that they may have gotten nervous themselves, and they helped maybe bid the stock up. I had talked about this being a sell up around 265. I had talked about it being a long down around the 61.8. I talked also that this area was a right or right out area, the 205s, that around here and here I'd be looking to buy. I was really looking more for the 61.8. But I will say this. When I saw the stock come out with the secondary, it was, I think, a $2 billion secondary, which was more than people were looking for, and the stock was down to like 198s in after hours, and then I noticed it closed flat in after hours. I talked about that this stock was going to go higher. It should be no surprise when bearish news comes out and a stock is green, you want to be long. When bullish news comes out, like in Home Depot, conversely, when bullish news comes out and the stock is down, you don't want to be long. You want to be maybe even short. It just means that the buyers are exhausted and there's no one left to buy. With Tesla, I guess the sellers got a little exhausted down here. Doesn't surprise me the 50% fib held. I really wanted to see the low here tested, at least the 195 to 191. I think that would have made for a much more solid anchoring point. But hey, listen, the news came out, and you got to adapt. So I will say this: if this number here, the 265, is challenged again, there might be a little bit of an initial back off, but at that point, I think we would retest the old all-time high and make even higher highs. Tesla tends to be bullish in the summer and peaks out toward the end of the summer. Anyway, I'm going to kind of end it there. Maybe not, actually. I wanted to show you one thing with Deutsche Bank. I like that we bottomed here with a still higher low, and it's kind of bouncing a bit. These stocks, if they lose these lows, I think you're going to start getting some credit crises talk. So just keep an eye on these. They're kind of the maybe the diamond in a coal mine, the canary in a coal mine, so to speak. If these start really losing these lows, things could get really iffy fast with the markets. I think that these are just victims of NERP and the negative interest rates. Morgan Stanley, this is also one I'm watching. The 26 level is sort of a neckline, I guess, from 26s to 20. Yeah, the 26s strike, just 26 in general. If we were to start losing that again and losing these lows here around the 25.85, so basically once you get below there, this to me would be a bit of a problem for the financial sector and maybe for the tape. I'm not a huge fan of fins. I've talked about this, that if you want to be involved in financials benefiting, if you think rates are going higher, I think you want to be in the insurers on pullbacks like Travelers. This could be getting close to a trend line touch soon. I'd be an interested right or right out long buyer near these reference lows. And MetLife has been acting okay. It's been kind of sideways here. It's in a range. I actually had played it long for a while, and I'm out of it now, but I would be an interested buyer on a pullback. I actually have to adjust my Fibonacci levels. But we are above the downtrend, so if you want to play long, I think it's okay. Anyway, that's my story. I'm sticking to it. If you're not following me on Twitter, my handle is @JustinPulitzer. If you like this video, hit the thumbs up below. Hit the subscribe button. You'll get notifications when I post new weekend review videos and special edition videos. Please leave me some comments. You guys and gals help me make the videos better. And, your comments definitely get factored in. Anyhow, let's have a great week. I'll be looking to do Periscope this week. I'm not sure what day. I usually tend to do it Wednesday or Thursday, so let's tentatively say around then. Anyway, we'll have a good rest of our weekend, and cheers.